So how do you pay yourself as an LLC? Well, all you have to do is log into your bank account, click transfer, and send money directly to your personal bank account. And that's it. Thank you for watching, and I'll see you in the next episode.
What?
Okay, in all seriousness, is it really that simple? Well, it can be, but it also depends. LLCs can be taxed in a number of different ways, and if you have a significant amount of income, then it may save you more money to learn the best way to be taxed, which will also influence how you pay yourself from your LLC. If you're new here, my name is Sherman the CPA, and I specialize in tax planning for businesses with over $100,000 in income over at mycpacoach.com. A lot of my business clients want to know the best way to pay themselves from their business. And today I'm going to clear all of this up for you. You are going to learn both the different ways in the LLC can be taxed and how to pay yourself based on your tax treatment. So if you own an LLC and you need some clarity in these areas, go ahead and click the like button below and stick around for the full episode for simple and easy to understand guidance. All right, so first we need to address the different types of LLCs and how they are taxed. For simplicity, there are only two types of LLCs. Single member LLCs, which are just LLCs owned by one individual, and multi-member LLCs, which are just LLCs owned by multiple partners. Easy enough, right? All right, let's dig a little bit deeper here. As an LLC, you can have the ability to elect how you want to be taxed. And you can be taxed in three primary ways. Number one, as a sole proprietor or partnership, depending on the number of owners you have. Number two, an S corporation. And number three, a C corporation. Now, the way you choose to be taxed will directly influence how you pay yourself from your LLC. Each tax status is subject to a different set of rules and requirements, and it's very important that you understand what is required from the tax status you're currently in. And even more importantly, you may find out that you want to change your tax status to reduce your taxes, which is what we help people do every single day at mycpacoach.com. With that being said, let's talk about each tax status and how you should be paying yourself from each. Tax status number one, an LLC taxed as a sole proprietorship or partnership. If you have no idea how your LLC is currently being taxed, then you're probably being taxed as a sole proprietor or a partnership, depending on if you have partners or not in your business. These entities pay federal income tax, state income tax, and self-employment taxes, which you'll find out that some of the other entities here do not have to pay. Anyway, when you are taxed like this, paying yourself is very straightforward as long as you are okay with the extra taxes associated with this tax status. You would simply pay yourself with what is called an owner's distribution, also known as an owner's draw. Now, an owner's draw is exactly what it sounds like, an owner's withdrawal. You simply withdraw cash from the business and pay the owners with it. You can do this by submitting a bank transfer, wire transfer, cash withdrawal, or you can simply write a check to yourself or other business owners. Now, the money you pay yourself is not directly subject to income tax. Instead, your income tax will be based on the income your business reports, whether you pay yourself or not from your business. When you are taxed as a sole proprietor or partnership, your share of business income is taxed to you on your individual tax return. And the money your business earns after paying for all of its expenses is what will be taxed as income to you individually on that return. And by the way, the money you pay yourself is not considered an expense. It's actually irrelevant when you are taxed this way because the IRS basically considers you and your business as one tax-wise. Because of this, people end up paying higher amounts of self-employment taxes when they choose to be taxed as a sole proprietorship or partnership. Tax status number two, an LLC taxed as an S corporation. Now, the number one reason why LLCs elect S-Corp status is to avoid the 15.3% self-employment tax. Without being some type of corporation, you are going to pay self-employment tax since you will be considered self-employed. But when you elect to be taxed as a corporation, this creates some separation between you as the owner and the business entity. And S corporations specifically are typically favored amongst business owners because number one, they don't have to pay any self-employment tax, and number two, they are not subject to double taxation like C corporations. Now, with that being said, paying yourself as an S corporation is a little bit more complicated. For starters, before you can take out any owner's distributions, the IRS wants you to take what they call a reasonable compensation, which is subject to payroll taxes. So basically, since S-Corps do not pay the 15.3% self-employment tax, they require shareholder employees to pay themselves a W-2 salary, which is subject to Social Security and Medicare taxes, which, by the way, is what self-employment tax funds anyway. But the logic here is that your W-2 salary is typically going to be less than your business profits, which will lower the total amount of those taxes you pay anyway. For more information on that, make sure you are subscribed to our channel. But back to the main point of this video, how do you pay yourself when your LLC is taxed as an S-Corp? Well, first, you need to set up payroll and pay yourself a salary that is subject to payroll taxes. And if you want to learn how to do this, then subscribe to our channel again, because I have a full step-by-step video that guides you through this. Then secondly, you can take owner's distributions to pay yourself from the remaining profits in the business if you choose to do so. Now, as it relates to owner's distributions in an S-Corp, you do need to be careful with the amount you take because it can trigger a taxable event. If you pay yourself in excess of business profits and contributions you've personally made to the company, then you can trigger a capital gains tax. This is due to the fact that there is now separation between you and the business now that you are an S corporation. So just like how you would pay capital gains tax on stocks when you receive more money than you put in it, you can also pay tax on your distributions if those distributions exceed the amount of profits in your business. Or more correctly stated, when it exceeds your basis, which accounts for your profits and your contributions. This is something that I constantly monitor for my S-Corp clients at mycpacoach.com. Tax status number 3, an LLC taxed as a C corporation. C corporations are taxed in several ways. Unlike the other entities here, C Corps are subject to corporate income tax on both the federal level and the state level. So when your business earns income as a C Corp, it will be taxed on a business level. Then when your business distributes the remaining cash to its owners, it will also be taxed as dividend income. So unlike S corporations and other pass-through entities, the distribution you take from your C Corp is going to be taxed directly. And if you put yourself on payroll, you will also pay payroll tax on the wages you pay yourself, just like an S corporation. So how you choose to pay yourself from your C Corp is a dynamic equation that should consider all of the different taxes you will pay based on the payment method you choose. But still, there are several circumstances where being taxed as a C Corp can be beneficial and save you thousands of dollars in taxes. For one, if C Corp tax rates are lower than your individual income tax rate, then having a C Corp can actually save you more money in taxes. And secondly, if you do not plan to take dividends from your business, because maybe you plan to reinvest a lot of capital or whatever the reason may be, then a C Corp may also be advantageous to you. With my clients at mycpacoach.com, I conduct an entity analysis to show them which entity will save them the most amount of money in taxes. Anyway, when it comes to paying yourself as a C Corp, the methods are very similar to what we've seen already here. On the highest level, it is not uncommon for the owners of C corporations to pay themselves, number one, a salary for the work they do in the business, and number two, dividends or distributions for the shares they own in the business. For more videos that guide you to less stress and lower taxes, be sure to subscribe to our channel. And as always, thank you for watching, and I look forward to seeing you in the next episode.